Okay, welcome to the Toronto Real Estate Podcast. Today we are going to talk about rates, real estate, and reality checks midway through 2025. My name is Ralph Fox. I'm the broker of record and co-founder of Fox Marin. And today we have friend of the pod, Jason Friesen, who's a mortgage broker and partner at Outline Financial. To give you context, they probably did, I would say, close to $1 billion last year in mortgages. So they definitely know their way around the lending landscape in the Toronto real estate market. Jason, so great to have you here. Today, we're going to take a deep dive into the current and future landscape of interest rates, mortgage trends, economic pressure points, and we're going to toss in a little about the Toronto real estate market and how that's going to be affected and what we could be looking forward to seeing in the fall. Thank you so much for tuning in. Please be sure to hit that like or subscribe button. And if you have any comments, we'd absolutely love to hear from you down below. Jason,
Thanks
great to have you here.
Always a pleasure to be here, Ralph. Excited to dive into this and talk about what I'm seeing, boots on the ground, talk about what's happening in the economy, and just try to unpack and unravel everything that's happening and how it pertains to Toronto real estate.
Good luck to us on that, let me tell you. But before we start, I'm so happy to hear you are no longer a vegan and you now have moved into eating organic grass-fed beef, which makes me just so happy. So welcome to the team.
10 years.
Amazing. Amazing. Well, if there's anyone who's watching this who switched teams, please be sure to make a comment down below. Okay, well, Jason, let's talk about it. Big news yesterday, or maybe not so big news. We had a
lack of big news, maybe.
Yeah, but it was the expected. Yeah. So we saw interest rates stay at 2.75%, the overnight lending rate, which is what was expected. Inflation came in or is hovering at that 1.9%, while core inflation still a little bit elevated underneath the 3% mark, but still definitely within range. We've seen our GDP contract 0.8%, 0.5%, somewhere in that range. The US just came out, and of course, they're at 3% growth. So much for the elbows up crowd. Jason, I know you practice jujitsu, so maybe you can tell us about your elbows up. We have Tiff Macklin, who came out and made a bit of a dovish speech and just talked about everything being data dependent. Lots of talk about tariffs, but the threat of the global trade war has basically dissipated as almost everyone except Canada now has some type of an agreement arrangement with the US. Good on Mark Carney for that. And market consensus is talking about 2 more rate cuts. So lots happening in this environment. I just wanted to give a bit of an overview, at least what I'm seeing. Jason, what are you seeing based on sort of this overview? And how are you interpreting things right now?
Sure. I think, we had a higher than expected GDP number for Q1, but I think a lot of that was a run up.
Yeah.
People making purchases, trying to get ahead of the tariffs. So it likely was a slightly inflated number. So, seeing the Q2 GDP kind of falls in line with the expectations more.
And also sentiment, though.
Yeah, exactly. I don't think anyone feels like we're booming right now in any way, shape, or form across any real sectors of the economy. And so I think it's in line with what the expectations were. Seeing, the Bank of Canada slightly shift to be a little bit more dovish and, at least put out there the possibility of rate cuts in the future, I think was positive news. But I think we're still so tied to the US, and seeing the Fed in the US yesterday, obviously they held rates flat. And it's looking less likely like the Fed is going to cut anytime soon. So I think that probably puts us in a spot where we will sit on the sidelines, at least for the time being. Market's not pricing in a high possibility of a cut in September, not a high possibility in October. It may be end of the year before we see a cut. I mean, the thing is, you can read 10 different economics reports and have 10 different points of view. I think the expectation is that, you said, 0.5. I think 0.25 is also a potential outcome by the end of the year or early next year. But to the point, it's going to be very data dependent. So every month looking at jobs reports, I think jobs reports, inflation has remained, taking, headline inflation out of the equation and looking at CPI, it's hovering around that 3% mark. I don't think it's at a point where it is elevated enough we have to worry about rates going the other way, but it is pause for cause right now. But, it's going to be dependent on seeing the next few months. It does look like from reading Macklin's comments that inflationary pressures could ease up in the coming months. So we'll see how that plays out. And then obviously watching employment numbers. We had a higher than expected jobs report looking at the employment numbers for June. We'll see what they look like for July. But a lot of those jobs were part-time. I think, there were 84,000 jobs and 69,000 were part-time. So, curious
and
to know.
How many of the new jobs being created are private sector versus public sector?
And I'd be curious to know how many of those part-time jobs are people that are taking a secondary job to be able to afford to live in our country with the rising cost of goods versus, people entering the workforce in a part-time basis. So again, it's going to be month to month. I think we're going to have to just, it's going to be data dependent, and it's going to be a roller coaster like it has been since Jan 1. If we look at where we were Jan 1 to where we are today, as far as the outlook, it's definitely changed quite a bit. And there's been a lot that's happened in the last 7 months.
None of which anybody really ever could have predicted. Like if you look back, it's not like, why didn't I see that coming? Or it's none of it in hindsight would have been predictable.
Totally.
And what are you thinking about? Like, I've been watching what's happening in the US with fascination in terms of the relationship between the Fed, which is run by Jerome Powell, and the government. And there is this notion that there should be a separation between the Bank of Canada and the Fed, and the government and politics should not be involved in the decisions because it should be data-driven, specific to keeping the markets moving and unemployment and inflation within certain parameters. And yet the lines are always seemingly blurred. And it looks like there could be a dramatic shift in the next 6 months with that relationship overtly changing in the US. And I'm just watching it, and I'm watching Trump going after
Powell nonstop.
$2.5 billion renovation of the Federal Reserve when they're theoretically losing $100 billion a year. It's interesting because politics is going to get mixed up in it, but it seems like there could be a dramatic change in that relationship. And I'm just watching all of this unfold because I think it will impact Canada as well. What are your thoughts on that?
Well, I think Powell's held the line just simply from the perspective that their labor market is not weakening. It looks at what their unemployment is like 4%, 4.1%. It's pretty low. No. And, inflation has been sticky, stickier than expected, both sides of the border. So I think he's had this fear of overshooting and cutting and watching inflation climb back up. So it's only going to continue to get worse, which then creates economic uncertainty for even the rest of the world. I think that's it. When you've got, the potential for there to be big changes at the Fed, that obviously will have a ripple effect across the board, across the world. So I think that's something that we should definitely be paying close attention to. So
it's fascinating,
it is absolutely
watching it unfold.
Yeah.
And the other thing that's so interesting is all of this tariff stuff is uncharted. Like there are so many economists projecting that these tariffs would cause mass inflation, which we haven't seen yet, but it's still really, really early. And I think part of Powell's position, which makes sense to me, is like, this is an experiment in this crazy cauldron right now. And right now we haven't seen inflation in the US as a result, but a lot of smart people are predicting that still could occur. So it does make sense with both Jerome and Powell and Tiff both keeping interest rates in their arsenal if they have to react to sudden changes with specific to liquidity, adding liquidity into the markets.
It also doesn't look like the U.S. economy is in that bad of a position either, right? So why not? Yeah,
not like us.
Why move forward with that where you can keep that in your back pocket in the future if needed, right? So interesting times.
So what are lenders? I mean, because of what you do, you're talking to lenders all the time. Like, what is their mindset when you talk to a First National or
they just got bought.
a Scotiabank? Yeah, interestingly enough, by Brookfield, but that's a whole other discussion. What are your thoughts based on like the temperature check? Like, are they nervous? Or is it getting harder to get deals done? Is there liquidity out there from the big guys?
There is. And I think just, looking at the purchase business kind of falling off a cliff compared to the last kind of 10 years, if you look over the last couple of years, purchase business has been way down. You're seeing banks.
Sorry, what do you mean?
Just the number of transactions are down, right? Significantly, like the number of purchases. So there's less mortgages being done because there's less purchases. So what I've seen is
to give context to the viewers, at the height of the market, 2021, 2022, we would have seen 127,000 transactions across the GTA. And we're looking at maybe hitting about 58,000 this year. So you're talking it's down by 50%.
Yeah. So what you're seeing is banks have been less focused on attracting new business and more focused on retention. So I've found that banks have been pretty aggressive when it comes to renewals. For the most part, I would say banks are open for business and they're lending. It's not the worst lending environment. It's not the tightest lending environment I've ever been in, but they're definitely going through. And also part of this is that banks are way overstaffed because volumes are way down. So when they're overstaffed like this, they have more time to go through every deal and ask more questions. But I would say there's definitely enhanced due diligence, but stuff is still getting approved. If you're a solid client, you really have nothing to worry about. It's just the extra steps I'm finding with everything. It's just that, there will be more questions asked. They want to really make sure they're dotting their I's and crossing their T's and doing that kind of stuff, but still very much open for business. Where I've seen a big shift is I would probably say that some of the like B or alternative type lenders, the ones where say someone has bruised credit, maybe, they're self-employed and don't show a lot of income. They have actually started to underwrite their applications way more, like they're tighter, a lot tighter. So they're asking more questions. They're, I'd say, doing less deals. I feel like they are probably, more worried. That segment of the market is probably the most exposed, especially if you're, someone that doesn't qualify based on having traditional income. 98% of the clients I work with through traditional income, qualify for the mortgage. So when you've got some clients that maybe are working in an all cash business or self-employed and don't pay themselves a lot of money, those are the tricky ones to get done. And then obviously I think, seeing people that are overextended and have missed lots of payments and have credit scores that are below 600, they're definitely obviously the riskiest to take on right now. We have been seeing mortgage delinquencies increase month over month.
Through your data, like through your
no,
clients?
So through across Canada, I think it's at 0.21 or 0.22% right now of all mortgages are in delinquency, meaning 60 days past due. Still so low compared to like the US. I think the US is probably at like 2 or 3%. We're at 0.21%. So significantly lower than, if you look at the US or the UK. But we have been seeing an uptick, seeing more and more mortgages go into default. And I assume some of that would be directly related to, impacted businesses through tariffs where people are laid off as well, that maybe don't have the savings to fall back on right away. Keep in mind, we went through COVID. Everyone got a mortgage deferral for 6 months if they wanted to. Those aren't really being offered anymore. I'd say banks are willing to work with people and are trying to not put people out on the street. That's definitely a big shift. That's the one thing that we've seen since COVID is that banks are much more willing to work with clients and find a solution. Whereas before it was like, you miss payments, we're selling your house. That doesn't seem to really be the case anymore. So I do see that banks are more willing to work with clients. But we have, again, been seeing an uptick, not a huge uptick, but just, every month you're seeing another bump up on mortgage defaults. And I assume that trend will continue, but I don't think it's enough to like move the needle or sound any alarms or anything right now, because it still is such a small percentage based on the overall amount of mortgages that are out there in Canada.
And in this environment right now, clearly there's less transactions moving through the system. Banks are, as you just said, doing less deals. Are you guys busy right now, and how are you impacted in this environment?
So I am quite busy, but it's, as I've said a million times, we it's just weird. It's a weird market. It's the best way to describe it, is that it's just simply a weird market. It ebbs and flows. 1 week will be completely insane. The next week will be quieter, and then it will be insane the next week after that. So it really does ebb and flow. I will say that I am seeing buyers definitely do their homework, do more due diligence, sleep on things instead of just rushing. I think in 2020, it was like you would go look at an open house and then have to decide 20 minutes after the open house if you were going to place an offer on the property. And
So
now
that's
it's like
20 minutes after the listing came out.
Totally. And now you can sleep on it a couple of days and do your homework and do your due diligence and, kind of think about, the decision a little bit more. So I've been seeing that and a willingness to let properties slip through their fingers if they feel pressured to move forward. I think that's it.
Sure.
There's a lack of urgency now. Just, clients would rather sit on the sidelines versus put themselves in a spot where they've overextended. I'm also seeing a huge push towards, and I say this also with every client should be thinking this way and being more conservative and not being as aggressive as we probably witnessed people over the last couple of years. But people are definitely diving deeper into the numbers, making sure that they're thinking about having a contingency in place, not overextending themselves. Can we qualify on one salary if someone loses a job? Things like that. So I've been seeing a more conservative approach to this, which, when you look back to 2020 and 2021, it kind of got out of hand. People would, I'd give someone a pre-approval and they'd call me a week later and ask if they could squeeze another 100,000 of approval out because they needed it because it was so competitive. And now it seems like clients are more willing to actually work through a budget with me and stick to that budget. And again, if it means they don't find a place, they don't find a place.
Who's buying right now? Are you seeing first-time buyers? Obviously, are you seeing any entry of investors? Is it upsizers? Is it downsizers? Like, where are you seeing the bulk of approvals or activity right now?
I think, we're not seeing as many move-up buyers that are trying to sell a condo and then look to get into a house just because obviously, the condo market has not been great. I have a lot of clients that are moving up from their starter home into the next step up, where you have a little bit more confidence that your house will sell in a more reasonable time frame than if you're trying to sell a condo. That's been a big part of my business, move up buyers looking to get into a house. They already own a house, looking to get into a bigger house or maybe in a better neighborhood. And then a lot of first time buyers that are looking to get into the market. Believe it or not, I've actually had quite a few clients over the last couple of weeks that have been looking to purchase condos. So I feel like, prices are at a level that are, it's low enough where there's actually, for a lot of people, some value there in getting into a place now. And a client that, if you were talking to me 3 years ago and said you had a budget of $5 to $550 for a condo, good luck. And now you can find something, right?
Yeah.
I think that's it. So I'm seeing more buyers looking at least poking around and seeing what's going on in the condo market now.
We've had, this is just so interesting that you're seeing the same thing we are. I would say across the board on our team, we probably have a dozen first-time condo buyers that we're working with that just kind of have come out of the woodwork in the last 6 weeks. We have, interestingly, in the last week and a half, seen an uptick in the condo properties we have listings on the market versus freehold. Our freehold is struggling and underperforming in the last 10 days, and our condos are overperforming. Now, expectations for condos are very low in terms of how they perform, and the freehold is much higher. So we're talking about expectations of how they're performing, but condos are selling right now, and some of our low rise is struggling, and we're seeing a surge of onboarding first-time buyers. And what is really interesting, going back to what you were saying, and we were talking about this in our team meeting yesterday, is we have a first-time buyer, and they have a budget of around $750,000. And we were talking about how much damage, like in a metaphorical way, like how far that money goes, like how that's a strong budget in the condo market right now.
Yeah, for sure.
I think that knowing where we've been is a very interesting thought. And one of the ways that I'm starting to look at the condo market is the prices are so far below replacement costs that it starts to actually make sense if you realize that there's nothing in the pipeline and it is not going to get cheaper to build in the future. And you've got a lot of people, I think, starting to think about this and have these discussions. And we're seeing it across the city, across the board, and we're seeing this uptick happening in real time right now.
I think you just have to be mindful if you're purchasing a house or a condo that, the way that people were looking at houses, like their stock portfolio in the 2020, 2021, how much is my house worth today versus a week ago, right? I think you just have to be realistic in understanding that, as the last 6 months have proven, it is a bit of a roller coaster. So I think you have to look at it as a longer term play if you are going to purchase a property, and not be disappointed if, 6 months from now there's a smaller, another dip, right? I think you have to look at this as like a 3, 4, 5 year kind of plan down the road. But to your point about the, amount of new construction, completely at a standstill. I guess is it 2028 when it starts to, we start to see less
going forward. There'll be zero.
Yeah.
There'll be purpose-built rentals galore.
Yeah.
But there will be actually nothing coming online that people can actually buy and own. And I think that will continue on for a decade. And once, immigration's quiet down for now, but once that starts ramping up again, because I believe it will, it'll be interesting to see how that changes the dial of the market. Because I think we will see a shift. When? I don't know, but it's coming.
If there is anything that's a new construction right now, what's the price per square foot? Like, how much is it at ballpark
16
today?
Toronto, 16, 1700. It's just the cost to build.
Yeah.
And it doesn't make sense for anybody to be buying pre-construction with development charges on top of it and everything else that goes with closing of these properties. It makes zero sense. So you have an environment where there are no investors out there, and it's typically an investor who's going to buy something 4, 5, 6 years down the road. But there just isn't anything being bought. I think typically we would see like 30,000 sales in a strong year. We're probably looking at below 4 for maybe
what's resale?
3,000.
What's resale price per square foot? How much is that ballpark?
900 to 1,100, depending on where.
Yeah. So why would you pay 1,600 or 1,700 to have someone hold on to your 20% deposit for 5 years for that? Yeah.
And you're not including all the closing costs.
Yeah,
so
totally.
That's why it's devastated. It will be devastated for a decade. And the only type of inventory we're going to see is purpose-built.
Interesting.
And I think people are starting to understand and see that. And I think that's why we're starting to see more activity starting to come on the condo side. Does that mean there's going to be a turnaround tomorrow? No. But I think it's the beginning of maybe stabilization that will play out over the next 6 months. I know a lot of people in a comment section probably will be very unhappy about that, but it's what's happening, and I think eventually what will happen.
It almost makes you wonder if, like, perhaps that foreign buyer ban, if there is a ton of inventory, maybe they lift it if you can buy for pre-construction or something. You know what I mean? Maybe there's some changes that are made to that at some point. I think, is it Jan 1, 2027? Is that when the current one expires? It's all.
It could be struck down in Parliament probably at any time. Yeah, I see nothing wrong with having people who actually want to come and own and contribute to our society. Maybe there could be certain aspects tied to that, but
limitations.
It never impacted the market. It never helped affordability. It might actually help bring back affordability if it's done properly. But yeah, we'll see. It should be something that's talked about more in terms of bringing back new supply, not rental supply, which seems to be the focus, but actually properties where people can own and have a stake in society and feel a little bit more invested and proud about their future. So we'll see how that plays out. But I do think that's a really good point, and it is something that should be entering the conversation if and when our parliament ever reconvenes. Okay, so Jason, tell me a little bit more about like what type of products are you seeing people move forward with? If you're talking about variables, are you looking at 3-year fixed, 5-year fixed? Kind of walk me through those type of conversations when somebody's refinancing or looking to make a purchase. Like what are they thinking and where are they moving? And what are you advising them?
So I would say if you look back to Jan 1, when there was more of a rosy outlook on the economy, I would probably say that about 60% of clients were taking variable rates at that time. Rest were taking 3-year fixed, 5-year fixed, very few 5-year fixed. I would say as of today, 90% of clients are taking fixed. Very small amount of clients are going variable rate. seeing, now three successive, Bank of Canada announcements without a rate cut in the feeling that it could go on, for the time being, and that there's no, definitive plans for any future cuts. I've had more clients shifting towards looking at fixed. The question is, how risk adverse are you? I know a lot of clients think about it as, we'll take a 5-year because it puts us on the other side of the US election cycle. It gives us some stability, some peace of mind. I break it down. Variable rate, that's the riskiest at this point right now. 5-year fixed, most conservative. 3 years, kind of in the middle. Your risk with the 3-year is, you take a 3-year and then rates are higher 3 years from now. So you renew into a higher rate 3 years, where if you took a 5, obviously you have the full 5 years there. It's a tough spot. It's a tough call. It's definitely not a one size fits all approach. I would say a lot of first time buyers are probably opting for peace of mind and going longer term, so 5-year fixed. But right now, it seems like it's a toss up between 3 and 5-year as the two most common products.
And Jason, can you talk a little bit about the difference between how rates are set on the variable side versus the fixed? Bank of Canada versus the bond market, and how that impacts rates? Because a lot of people don't have clarity on that.
Yeah. Well, that's it. It's like, I think, I get phone calls from people when there's a Bank of Canada rate cut. Did my fixed rate go down? No. So the Bank of Canada directly impacts the prime rate. So the overnight rate sets the bank prime rate. When you take a variable rate, what you're approved for is a discount off of that prime rate. So as the prime rate goes up or goes down, as the Bank of Canada adjusts rates, so does your interest rate. So, there's 8 possibilities in a year if you take a variable rate that your payment could go up or go down. 8 possibilities because there are 8 set announcements every year. The fixed rates, on the other hand, are tied to bond yields, which heavily track US Treasuries. So seeing, this delay in the Fed looking to cut, seeing inflation coming in higher than expected, seeing the economy do well, those have pushed Treasury yields up, which had then put upward pressure on fixed rates. So I think that, the reality is that the US economy has the largest impact on fixed rates in Canada, not what the Bank of Canada says or does. In fact, like, you can look at bond yields and look at Bank of Canada announcements, and you could have US make an announcement about something or something, an economic indicator come in stronger than expected. Yields would be up on the day the Bank of Canada cut by a quarter point. So they don't move hand in hand. They, fixed rates move, in anticipation of the expectations of the central banks, mainly following US Treasury, so following the US Fed. I think that's the big misconception, is every time the Bank of Canada cuts, did my fixed rate go down by a quarter point? That's not the case. It has more to do with what's going on in the economy. Fixed rates can change daily. I would probably say that there's an increase or decrease to fixed rates as it stands over the last 6 months. Every 14 to 21 days, we're seeing a small uptick or small downturn on where fixed rates are. For the most part, fixed rates have hovered around that 4% mark. They're slightly higher today, but around that 4% mark. They've been slightly below 4%, slightly above it, but in that range since January. So I'm not expecting to see any drastic changes to fixed rates as it stands right now, unless we do start to see some weakening in the US economy and we start to see a signal that the Fed is likely going to move to cut rates. That will likely bring down fixed rates, but not until we see that. So I think it's very much going to be kind of where we're at right now. And here's the thing. I think the real estate market works at 4%. Having rates at 1% and 2% were not, it wasn't something that was going to be there for forever. And, I think that other concern about there's a mortgage renewal cliff, no one's going to be able to pay for their mortgage. I have not had a single client that I've spoken to, and I've probably talked to 200, 250 clients this year about the renewal that has had to sell.
Can you repeat that again, just so that everybody's clear on
one
this?
Client has needed to sell. I've been seeing more clients that were, instead of making lump sum payments, like extra payments over the last 5 years, they looked at as, well, I was paying 1.6%. Why would I pay down my mortgage? I just have to beat that in after-tax rate of return in my investments. But now that they're up for renewal and looking at higher rates, they're taking that money and paying down their mortgage, right? So maybe they're making a $50,000 or $100,000 lump sum payment. I've been seeing that quite a bit. I've also had some clients, worst case, that have needed to refinance. So they've needed to pay out some high interest debt, maybe roll in a line of credit, things like that. And then one of the other options that does exist as well is that you can, if you really feel the crunch, re-extend your amortization out. And I'm not a fan or an advocate of this, of saying, yes, you should, pay your mortgage off indefinitely. But for some people, it's a difference between being able to, afford, a life which, let's be honest, everything costs significantly more than it did 5 years ago. So I've had some clients that are looking to do that as well. So, but again, not a single person that's needed to sell. Keep in mind, everyone is qualified at an interest rate. So that stress test rate was higher in 2020 and 2021 than where our fixed rates are today. So everyone in theory is already qualified at a higher interest rate.
And what's so interesting is we're having the same experience. So when we are selling properties or bringing properties to market or have properties on market, none of our clients have to sell. There's situations where people are like, we're having a kid, we need more space, we're getting divorced. There are just so many instances where people are making life transitions right now. And that's what's driving the market, not investors. And so people who are selling these properties, or our clients who have these properties on the market, it's crazy. Like, we'll wake up to the morning and somebody just sent in an offer $130,000 below list price. And we're like, no, there's no need for us to accept this. We're very reasonably priced based on market sentiment. We'll wait. And we had, with 2 condos last week or 2 weeks ago on the market, we received 2 offers, one on each, 100 some odd thousand below list. We said no. And a week later, or less than a week later, both properties sold very, 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 very close to the actual list price. And so there's people out there that I think are reading these headlines thinking that these type of opportunities are out there because people are desperate and hurting. I'm not seeing it. It doesn't seem like you're seeing it either.
Oh, was it Wayne Gretzky that said you miss 100% of the shots you don't take? People are just throwing it out there, hoping they find someone that's desperate, right? I'm sure, you send 5 offers in, maybe one gets accepted that much below because someone's in a bad spot that they need to sell, right? So,
but the point is that we're not seeing that based on our client mix that's operating or selling in central and downtown Toronto. And I think even though there's that slight uptick in people that are over 60 days on their payments, it's really not the current market reality, at least in Toronto, based on what we're seeing. And I think that's why prices have held. I mean, the average condo price is still holding at $730,000 or whatever it is. And we're seeing, the average sale price still holding over $1 million or in the $1 million range. And it's because of that. So unless that changes, I think we're going to continue to see relative stability with potential downward pressure on pricing, but it's not going to be the apocalypse or the Armageddon that everybody is hoping for in our comment section.
I just see clients that, they'll reach out and we'll have a conversation about, that next move and what it looks like. And maybe a week later, they circle back around and say, you know what, we're just going to stand pat. We're going to stay in our condo for the time being. So they're not desperately, to your point, trying to sell. They're going to ride it out and see how it goes. But, not take a giant haircut on a property just because, right? So, and I think that's why the prices reflect, modest reduction. You're not seeing huge cuts. I assume people that are trying to sell assignments, because I guess that is, a market you don't have a lot of data on. It's probably a bit of a different story if you have a new construction, but in the resale market, it seems to be pretty stable.
Yeah, I mean, the assignment market is the dark market. So it's really hard to know what's happening there, but there are no real buyers unless somebody is literally fire selling a property. And I think if you're looking at fire sales, that's where it's going to happen, where people just are an ability not to close or default and they just want to get out. But those opportunities, finding and recognizing them, is not necessarily the easiest, especially knowing that there's just not a lot of investors out there who want to still buy off spec and or inherit those development closing costs. So one thing I want to talk to you about now is my favorite topic, Toronto real estate market. Yes, we're seeing a continued buildup in inventory and softening and downward pressure on pricing. What are you seeing in your conversations with your clients from the perspective of buyer psychology? And like, what are they thinking and how are they navigating the market through the lens of financing? Because oftentimes when somebody reaches out to us, we put them in touch with you or their lender so that we need to understand what their budget is before we can start to give them a little more informed opinion and start to show them what their options are and the pros and cons to what's going on in the market. So when you're having these early conversations, like what does that look like, and what's sentiment like?
Again, I think it's really more focused on budget, heavily focused on budget versus how much they're qualified for. They have a number in mind they want to stick to. And then
when you say budget, are you talking like a monthly budget?
Monthly budget. I always look at everything, break it down monthly, all the housing expenses, not just the mortgage, but property taxes, all the utilities, maintenance fees. Do you have childcare costs, things like that? We try to build out a budget that way. So again, I'm seeing more of a willingness of people just to stick to that budget. Later on, when clients are looking at properties, I'm just seeing a willingness to let properties, go away if it doesn't, if the seller is unreasonable or there's going to be competition or it goes above a certain price point, there's just a willingness to walk away and let things go and not get themselves carried away and caught up in the craziness of the market like it was in 2020 and 2021. So I've definitely seen a shift to a more conservative approach, that's for sure, which is obviously not a terrible thing. And then again,
not at all.
I think there's less fear of missing out on something now. If it's not meant to be, it's not meant to be. I think that's it. And just the fact that, I'd say there's a way less sense of urgency. I'm sure you're seeing that on your side as well. Someone will look at a place and then say, I'm going on vacation for a week and then come back, right? It's, they'll deal with it. If the property's still there when they come back, great. If not, then there will be another one. So I just feel like there's just way less urgency on everything. But the clients that are reaching out that want to get into the market will go through the pre-approval and send me everything right away and want to get some numbers going right away. They want to start looking. But again, the budget is the number one focus, as it always should be. The budget and sticking to a number and not going above that has been a big play here. And then also, I'd say my favorite part of this is so many offers have a financing condition in them. Now it makes my job so much easier. That's crazy. It's to see so many offers with financing conditions.
Yeah.
A little trick: if your offer has a financing condition in it, your approval gets bumped up faster than something where there's an unconditional offer. So if you want to get a faster turnaround on your full approval from the bank, put a financing condition, and they prioritize financing conditions.
Interesting. That makes sense because it's a time-sensitive deadline, and the pressure moves to them off of the purchaser. That's an interesting little tidbit there. And it is something we are seeing. And there are multiple situations where we, with low-rise properties, are having offer days, and even the successful offers are having conditions in them. So, and I don't necessarily think that's a bad thing. I think everybody, including the seller, is always best off knowing that the covenant is solid with a buyer.
Agreed.
I think a buyer should be very clear on what they're buying. So, you don't get that quick win having something sold firm on an offer day that you did in the past. But I do think it is an indication of a more healthy market, both for buyers and sellers, more transparent and allowing people to really do their due diligence and not get caught up emotionally. So I do think it's a good thing, but we are seeing that on our offer days where we have multiple offers. We had a property at Yonge and Davisville that had 3 offers earlier this week, and all 3 had conditions. Not something you would have seen a couple of years ago.
No way, not at all.
So that's a very interesting shift, and I'm glad you brought that up. So talking about the fall, what are your predictions right now looking into the fall? Let's talk about rate cuts. Like, even if we get 25 basis points, or let's say on the maxi side, 50 basis points, do you think that will move the market, or what impact do you think it will have on the market? And where do you think we will be, knowing that everybody's wrong perpetually about everything? But where do you expect we'll be by the end of December?
That's a tough call. I think.
Oh, I said it was a tough call.
I would probably say, from my perspective, I think we at best get another quarter point cut. But I think just seeing a shift to seeing another rate cut will likely provide some comfort to people that are potentially looking to get into the market. I think when rates are continuing to drop, I think it shifts a buyer mentality. Like, they're not, setting themselves up for a point where rates are going to go up. I think it's just a mindset shift of having rates drop, even if it's only a quarter point, just on how it will impact things. I hope that we continue to see supply slow down and see some of this inventory get bought up, and I think that will be healthy for the market. It's a tough call. I have no idea where real estate is going to be. Hopefully, things are chugging along and we see an uptick in the number of purchases. But as the last 7 months of 2025 have shown, who knows? I think that's the answer. Who knows? How about yourself?
I think we'll continue to chop up and down in around the same range in terms of transactions. I think it will be muted but calculated. I think condos may start to stabilize a little bit. That might be a little controversial and admittedly a little premature. And I may have a little confirmation bias in that. So I'll give that a little bit of credence. But we are seeing an uptick in activity and in buyers coming. So there's a lot of inventory to chew through. And I know there's also a lot of inventory sitting on the sidelines that's just waiting for better days so that they can get out of their trapped condos that they bought in 2021 and make the move up that property ladder. So I think there's a lot more hidden inventory waiting to come out. So it's going to take a while, I think, for this to play out, but it is nice to see a little bit more interest in that market segment, which I think will continue and hopefully give us a bit more stability. I think
we need stability south of the border as well. With we need to figure out what a trade deal looks like and have some understanding of what things look like. I think that's part of why there's been a pause in anyone doing anything, as well as that everyone's just waiting for the next shoe to drop, right? Like what's coming next. So I think that's it.
We do need certainty, and I think that really is the theme of the Toronto market right now. And not the market. I mean, it's much bigger than that. It's the economy, it's business, it's sentiment, it's life decisions, it's travel decisions. There's just so much uncertainty right now that's really affecting most people in all of their decision-making aspects of their life. Real estate just happens to be a part of that. And so I do think having stability there, and also just, I think, seeing our economy, where it's going to go, and is it going to start to turn around, and is there going to be a little bit more optimism there as well, and a little more stability. So I think that's going to be the major thing to watch, both in terms of looking at key indicators and just psychology and sentiment. And that will ultimately determine where the market is going to go from a demand and supply standpoint on the short term. And so I do think that is something to watch. I'm hopeful that it will come sooner rather than later. And I think everybody will be able to breathe a little sigh of relief, thinking that they can actually be in a position to make midterm and short term, not long term, but even long term, midterm, and short term decisions, which I think will be really, really helpful. I'm leaning towards that playing out over time, because I think it has to, and I think it's in everyone's best interest for that to happen. And I think as that happens, the market will continue to stabilize a bit more, and our economy may strengthen. I do think we probably will see the two rate drops coming. That seems to be the consensus. Do I think it's going to move the market? No, I do think that it will help buyer psychology. And I also think that the governments, both in Canada and the US, are going to be doing what they can to see those bond rates fall, because our debt is so huge, and our debt payments. I mean, they talk about, in the US right now, their debt is greater. Their debt payments, servicing payments, are over $1 trillion, and they have a lot of short-term debt renewing. And so there's a lot of pressure there to see the bond market come down on the long-term end. And it's the same thing here in Canada. I mean, our debt payments basically are more than our healthcare payments. It'll be interesting to see how all of this plays out. I think there's incentives to see these rates come down and to see more stability. And hopefully we can end up there. And I think that will have a positive impact on the market. Where we thought we were going to be in January, but never happened, maybe it'll play out for end of this year going into 2026. But time will definitely tell. Okay, well, I think after that soliloquy, we've covered everything here. Jason, thank you so much for joining us. Where can people find you?
www.outline.ca.
Okay, awesome. Jason, thanks again for joining us. If you've made it to the end of this conversation, we thank you so much for tuning in. Please be sure to hit that like or subscribe button. If you have any comments, please be sure to keep them above the waist but below the line. And we look forward to hearing from you. And Jason, we certainly look forward to having you back on the podcast and seeing where the world is in a couple months' time from now. Jason, thank you so much.
Always a pleasure. Thank you very much.